Good morning. This is Sherwood Tucker with American Ag Marketing from downtown Chicago on this November the 9th, 2013, and wanted to bring to you a special report that we put together after the USDA report, specifically on corn and some trading ideas we have with the corn market after yesterday's announcement by the USDA. But first, let's go through the report and the numbers and see what they had to say here, if you haven't read them already. The harvested acre number came in for November 13-14 at 87.2 million acres for corn, down about 2 million from the USDA's estimates of 89.1 million harvested acres in September. In soybeans, they came in at 75.7 million acres, slightly lower than the September estimate of 76.4 million harvested acres. Pretty neutral. That would be pretty bullish for corn, except that they came in with the bushels per acre at 160.4 for corn, and they last estimated in September at 155.3. So that offsets the harvested acre lowering of about 2 million acres in the corn market. Soybeans came in at 43, which I think was extremely bearish, considering that the trade's really been focusing on a 42 or lower BPA for beans. USDA did estimate 41.2 BPA back in September. In the total production of the U.S., corn was pegged at 13.989 in this report, up from 13.843 billion bushels in September's estimate. Beans were also slightly raised at 3.258 billion bushels compared to September's 3.149 estimate by the USDA, which both those numbers you would think would be a little bearish for both markets too. In total carryout, the corn was put at 1.887 in this November's report, compared with 1.855, which is slightly bearish, and beans at 0.177 versus 0.15 from September's USDA report. The world carryout numbers for corn you would think would be extremely bearish, coming in with a carryout worldwide of 164.3 in November versus 151.4 in September. Beans on a worldwide basis look a little bit bullish at 70.2 versus the 71.5. So it was USDA lowering that number here a little bit in this report. Now, some fundamental excerpts, I guess, from the report, specifically for the corn market, were, if you do look at the chart, values and prices did close higher on Friday, up about 7 cents in the March futures is what we're looking at here on extremely heavy trading and volume. And that's even with the USDA forecasting a record corn production number here. So you got to think a lot of this was built in before the report, expected, that type of thing. And the USDA also estimating a national corn yield of 160.4, which, as we said before, is offsetting the lowering of the harvested acres numbers, which were down by about 2 million from the September report. Again, total U.S. corn production's pegged at 13.989 billion bushels, which is a little lower than the 14 billion magic number a lot of people were looking at. So what we believe is this is going to set the stage for producers to store a record supply of corn this fall after harvest here. So the USDA is also forecasting a carryout of 1.88 billion bushels and corn feeding up 867 million bushels, or 20% from 1 year ago. Of interest, the USDA's estimates saw a record average 7-state ear count per acre. Illinois' yield was up 15 bushels from the September estimate, Iowa up 7, Indiana up 8, and record yields were reported across Illinois, Indiana, Ohio, Pennsylvania, and the Carolinas. And the USDA is also increasing the U.S. corn export forecast by an additional 175 million bushels, with total exports to nearly double at 1.4 billion versus 731 million last year. Most important to us is the U.S. carryout to use ratio. It's being pegged at 14.5%, which definitely moves the U.S. supply-demand situation back to clearly oversupplied levels that haven't been seen for years. So seasonally, now we're here in the fall, moving into the winter, with the producers projected to hold and store a record amount of corn. The trade is definitely going to start debating if prices are going to move back into a pre-2008 pricing model. And a reasonable analysis of pricing models and statistics at this point could suggest that the futures prices do deteriorate slightly below the $4 level into February 2014. Obviously, that's a guesstimate. It's based on pricing models, statistics, probabilities, that type of thing. So with our short-term recommendation in the futures markets is basically we're looking to go long this market. We're expecting a rally here after the number came out, and by all means you would think that corn would be down lower, beans would be down lower, but the market's telling you something different, and that's what you have to listen to. I really like the chart structure here, especially on higher volume with a higher close. So I think it's worth taking a shot at. Obviously, nothing's guaranteed or 100%, but we like to pick our spots and think this is maybe a good one here for a rally. So if you're looking to do that, if you're more speculative in nature, you could put a buy stop in above Friday's highs there, and then either set a stop based on charts, which I'm not a huge fan of that. So you could put a low in below Friday's low, which you'd be looking at maybe around an $800 risk per contract. And I like to set stops off the average true range based on volatility. So you're looking at a little bigger stop there, about 25 cents if you decide to go that route too. And if you have any specific questions and prices that we're going to do exactly, feel free to give us a call, and we'll be more than happy to help you out and answer any questions you may have on this trade. Also, if you're more comfortable using options, buying calls or puts in any situation, we're well versed in that, can walk you through different option strategies to take advantage of this trade with lesser risk, obviously, than using the outright futures contracts, which we like to do a lot too. Our first price objective is around the $5.05 range. That's kind of what we're targeting here if things do kick off and we get a post-harvest rally here and the market starts to go up. So with those numbers, you're looking at about a 4-to-1 risk-reward ratio if that were to come to fruition, which at minimum, that's where we like to start on risk-reward. As long as you're disciplined, keep your stop orders in, and get out if it's a losing trade, keep your trading account intact, then you always want to kind of be looking at 4-to-1 or higher risk-reward ratios. If we do get to that price objective, then obviously we'll reevaluate the market, see if we want to continue to see if the trend develops and goes higher and ride the position. Obviously, we'll adjust stops along the way too. And again, if you have any questions on this trade specifics or using options and how to take advantage of it, feel free to get in touch with us directly at 312-987-2072. Also visit our website at www.americanagmarketing.com. And feel free to send us an email. If you do visit our website, feel free to sign up for our blog. Just takes your name and email. We ask for a phone number. It's optional to do that, but it'd be great if you want us to get in touch with you. Please put your phone number in there. We're not pests. We're not going to harass you, so feel safe to sign up for the blog. You'll get all our research ideas and also other commentary that we come out with daily on every market, basically. So anyway, have a great afternoon, and thanks very much for your time. Be safe this weekend, and we'll see you on Monday. Thank you.